For those who tuned in quarters past, welcome back. For those that are new to this webinar, our goal is to keep this pretty casual. My name is Austin Hageman, and I am joined by Adam Armstrong. We're both advisors at Withum Wealth. Adam and I are going to have a fireside chat type discussion, highlighting just a few of the many slides the firm's content committee has put together in our quarterly market update. We do want this to be more discussion-based, so please feel free to ask questions using the question box on your screen. We'll try to answer as many questions as we can, and if for whatever reason we cannot get to a specific question, we will reach out to you after the webinar. We do have some viewers that are not clients, so a quick 30-second background on the firm. We are an independent registered investment advisor offering wealth advice and portfolio management solutions to wealthy individuals and institutions. We are what's called a true fiduciary and sit outside of what I call commercialized Wall Street, in that we do not sell products or get paid to push specific investments or any personal finance solution for that matter. Plain and simple, our clients pay us to offer quality wealth management advice, and we do not receive any other type of compensation on top of that, meaning we do not have a hidden agenda. We also have institutional investment reach, allowing us to offer clients a vast, unconflicted investment universe, as well as access to not just one, but multiple private banks and other financial institutions. How did you, Adam? Did I miss anything?
I think you covered it all.
All right, let's charge forward. What do you want to talk about first?
Well, we concluded the Q1 market presentation by saying we would try not to talk about inflation again, but alas, here we are. So let's jump back into inflation, hopefully for the last time. But we've seen inflation tick up over the last couple of months, not just on the CPI readings themselves, the consumer price index readings themselves, but a number of other measures such as wage growth, producer price index, so what's the cost of input goods into products, things of that nature, which has been what the Fed was probably not hoping for. And it's having implications throughout the bond market. So we want to talk about inflation in the context of that lens, and specifically, what was forecasted as 3, maybe more rate cuts this year going away. So you can see the blue line here that you're about to draw next to. It has come down a long way from about it was 9.1, I believe, at the peak on an annualized rate. And the last, call it 2 months have been a little concerning. We've seen this number, get down to 3 and then sort of bounce and hover at those levels. I think we're around 3.5 right now on an annualized rate. So not ideal. It's not exactly what the Fed was hoping for. We wanted to see a little bit more momentum heading towards that 2% range. And, we can go ahead and I think we should pat ourselves on the back by saying the last mile, or that from 3% to 2%, is going to be the hardest for them to achieve.
Right. And it does appear that we are trending in the right direction to see perhaps a 2% rate by the end of this year, maybe first half of next year. But there are a lot of what ifs out there. I think it's interesting to see that we are below the 50-year average, right? So we're not quite at the 2% target for the Fed, but we are below the 50-year average from both a headline CPI and a core CPI standpoint.
Yeah, the Fed's 2% goal is, I believe, fairly arbitrary. And, historical inflation is somewhere in the 3s. So we're sort of around where inflation has always been on average.
Right.
So just real quick, this chart should be familiar to people that have seen this presentation a few times at this point, but this just looks at the individual months of inflation. So how much did prices rise in the last month? And we can see January, February, and March of 2024 on the right side here have all come in hotter than expected, both from a reporting standpoint, but above that sort of 0.1 to 0.2 level that we need to sustain to hit a 2% annualized rate. So this is what's spooking investors a little bit. The market, if you remember in our winter presentation, the market was expecting more like 5 or 6 rate cuts throughout this year based on the futures prices of the 10-year treasury and other bond markets. at this point. And then in March, the Fed came out and said they reiterated 3 rate cuts that they expected to see this year. The market is now projecting 1, maybe 2 rate cuts this year. I think this morning there was another inflation data point that came out, and it might even be under 1 hike now for the remainder of this year. So the market has seen rates rise across the board over the last couple of months. And I think that's why we're getting a little bit of market volatility as far as
Right.
stocks are concerned.
And I think that's important, right? A lot of the sell-off, I don't even know if I can call it a sell-off in April, right? The letting out of steam, the trickle down, I think can be drawn back to the Fed statement, inflation, and the fact that the market is now repricing from 6 expected rate cuts to 2, maybe 1 by the end of 2024.
Right. It
Right.
doesn't mean we're going back to where we were in October before the Fed said they were likely done hiking rates. And it's not like we think a rate hike is coming. It just probably means that the cuts are going to be postponed further out into the future.
Right. And this isn't unusual, right? You don't typically see something move in the right direction consistently from point A to point Z. You typically do see some stumbles along the way, some pullbacks here and there. It's a good thing. It means that the market is responding to the data, right? And it is what we expected coming into this year. We didn't expect it to be all, rose and sunshine. If it was, great, but as investors, right, we need to come in with a more of an honest and an honest understanding of what's ahead of us. And so this type of environment where we don't have inflation cooperating as much as the average investor thought, it makes sense to us. This is normal to us.
Yeah, this is probably happening for a few reasons. The fact that the consumer is still really strong, and the fact that the economy has been very resilient despite 5+% interest rates for almost a year at this point, that's a good thing, right?
Right.
We have full employment, which we're going to talk about in a little bit, the labor market, the state of the labor market, but people are spending still. So that is a good thing for economic growth. It's a good thing for company earnings, but it might mean that these higher rates are going to be around a bit longer until inflation is really under control. Or hopefully they're not high for too long and it starts to actually lead to economic weakness.
Right. Yeah. And then just to highlight what you said, right? This pause or this change in idea of when the Fed's going to lower rates, or of the Fed's reluctantness not to lower rates, isn't a bad thing, right? Because it means that the economy is actually doing well. It means companies are profitable, people are making money, and people are spending money. In order to get inflation down, you really need people to spend less money. And typically that's associated with people making less money, right? So it's not necessarily a bad situation that we're in right now. The hope is that the Fed doesn't wait too long to lower rates, but as long as they stay data dependent, they're looking at what's going on in the economy, and hopefully will lower rates at the right time.
Higher rates are, for some consumers, a good thing. If you have excess cash, if you have a bond component of an investment portfolio, all of a sudden you are actually receiving meaningful yield on that part of your wealth, right?
Right.
Let's say you had an excess savings in cash before, 3 years ago it was earning nothing. Now it's earning 5% in a money market fund, 4.5% in a high yield savings account. That's great. With inflation at 3% or 3.5%, and you're earning 4.5% or 5%, you're making money, right? A lot of people, their mortgages are sub 4%. I think, 70% of this country has a mortgage under 4%. So if you can get, 5 in a money market fund, you're profiting in that standpoint, right? You're coming out ahead. So that's actually, these high rates could be, a tailwind for consumer spending in and of itself, ironically.
Right. There's a segment of investors who are actually thriving in this environment.
Yeah.
So I know you wanted to talk a little bit about the economy and the strength in the labor market. So let me flip to that.
Yeah. So why is inflation being stubborn? Simply put, the labor market is looking pretty good. So we have broken out on this slide and the next slide, which we'll get to. We've broken out the labor market into labor supply. The workers that are in the workplace, what's their situation, and then labor demand, who are the hiring folks out there, companies, CEOs, et cetera, in charge of hiring, and what's their sentiment looking like at the moment. So from a labor supply perspective, on the left side here, you can actually see the non-farm payroll gains month over month. Going back a few years, it's come down a lot, but we see this upward trend in the last few months. These are seasonally adjusted, so it has nothing to do with holiday season or anything like that, and it's continued into January, February, March. Payroll gains have been strong. People are still being hired at a healthy clip. To me, I don't think we can say we're even close to a recession or in a recession if we're hiring over 200,000 people each and every month. That seems like it doesn't sync
Right.
up. On the top right here, we have the labor force participation rate. So this is the percent of the population that is actually actively participating and looking for work. And you can see prime working age, 18 to 64, it hasn't been higher in the last 10 years. Okay, so the amount of people that are able to work and are working or looking for work it's higher than it was in 2019, which is a great thing. It means more people are earning income or able to earn income, and those people can then go out and spend. So this is a very encouraging sign. And this is a bit on the bottom right, a bit of a hot button issue from a political standpoint. We're not going to take it there, but over the last 3 years, a lot of the payroll gains and labor force growth has actually come from foreign-born people in the United States. Okay, so those 3 years have been higher in terms of their responsibility in the labor force participation growth rate year over year than really the last decade plus. So a lot of those jobs, when you go out to restaurants now, you don't see help wanted signs everywhere. A lot of them are, lower income spectrum service jobs, which is needed in our economy to help it function. But those folks have come here from somewhere else to seek out a better life and are more than willing to take those lower paying jobs, which is a great thing for the overall U.S. economy, helps things flow more efficiently.
Right. And
So that's an interesting point. I just wanted to signal
yeah,
that.
definitely. And another factor here that we don't have shown in a chart is the work from home culture, right? In the past, we've had spouses or, people charged with taking on more of the household's functions, weren't able to go to the office, right? They had to take care of the kids, take the kids to various different, whether it's school or sports, et cetera. Now with a bigger work from home culture, we're seeing more and more people be able to balance, managing the household and also logging in on their computer and getting work done. So that's also helping support the labor force as well.
Yep. Yeah. So labor supply is looking very strong. Labor demand is, a little more up in the air. I would say it's still maybe out of whack due to this work remote phenomenon that we went through. But we'll highlight a few things here. Job openings. This was common talk after the pandemic in 21, 22. There's so many jobs out there, but no one's working, right? The job openings have come down a lot. This is a phenomenon you tend to see when you are entering a recession. Before each of these gray lines on that chart, you can see a major dip in the job openings available. But we were starting from such an elevated level. The job openings are still well above where they were in 2019 or even in the 90s before that. So we've come down from just an astronomical amount of job openings.
Right. Where we are is still healthy, right? Even though we've dropped so much, where we are is still pretty healthy.
Exactly. If you want work, you can find it, which is a good place to be in. You don't want there to be a lack of jobs. So it's worth noting, though, that these are coming down. Maybe that is some effect of AI and increased productivity from, the workers that are hired in this economy at the moment. It could be a sign that business owners and CEOs are, reducing their hiring goals in preparation for a weaker economy ahead.
Right.
To be determined.
It could be that CEOs are doing what they should be doing is, getting into a more defensive posture. They know what the environment we're in. They know what the risks are. One of those risks is a recession, right? So they're not hiring those excess jobs, or they're letting those excess jobs, those people retire and then not hiring replacements to kind of put that business in a more defensive posture, right? Not because they're expecting revenues to drop significantly, but just in case, right? Just to have that safety measure to do what you're supposed to do. They're managing a business.
Right. And, on the top right here, we have the number of quits in thousands seasonally adjusted. People have been voluntarily quitting their job less. So this could be a few things because labor is not in such demand across the board anymore, as we can see by the job openings. Maybe people are not receiving the massive raises just by switching companies in the same role, right? So the benefit of switching jobs right now has come in. That is reduced. Fewer people are quitting their jobs, but we're still on par with 2018, 2019, before the pandemic level of people quitting. So we came down from this astronomical level again, but we're still at a very normal level. Although this too is a trend that you tend to see people stop quitting their job when they're not as confident in their future outlook from a financial standpoint. So this could be one. It could be the fact that there are less job openings. People are getting less raises by jumping ship. Or it could be the fact that consumers are actually, they're still spending today, but looking out ahead, maybe my budget's getting a little tighter. To
Right.
be determined again.
Yeah. We're not seeing that culture of if you switch jobs, your income jumps 10 to 20% anymore, which
Right.
isn't necessarily a bad thing for businesses as well, because the longer you keep your employees, the more efficient theoretically they are, right?
Yeah. And, from a layoff perspective, this is something you just don't want to see jump up. And it's pretty much been at the levels it has been, for the last year or two, call it. And there are high profile layoffs. Amazon, Google, Facebook have been in the news. Microsoft, I think, had a round of layoffs. Again, maybe these are all tech companies that are probably becoming much more efficient with AI ahead of, a company like Walmart or whatever it might be. So layoffs haven't skyrocketed, and that's a very positive sign. That's something you would see probably in a recession or in a weakening economy. So it's comforting to see that we're not in a bad place from a layoff perspective.
Right. So we potentially have businesses getting a little bit more conservative, right? We have the Fed with higher rates because we are in a good economy right now, and inflation is not coming down because people are making money and spending money. But there is this concern that the Fed's going to leave rates too high for too long. So I did want to revisit a slide that we've shown in the past, not the recent past, but certainly the past, is this slide on duration, on being a bond investor. And, when we look at history, what history kind of tells us of where we are now and what we should be thinking about.
Yeah. So this is a great chart. And I think to set the stage for this, in the fall, when the Fed came out in end of October and said they were likely done hiking rates, we started pricing in rate cuts into the situation, and you saw this phenomenon play out a lot. And now we've repriced it, almost like that was a catalyst for more economic growth and more spending when rates dropped, even though they didn't even cut the short-term rate, right? And, at that point, we saw this sort of reacceleration of growth through Q4 and Q1 of this past year. Growth looks like it's coming in the mid 2% for the current quarter. So, people were talking soft landing, no landing, hard landing. I think we had a no landing situation over the last 6 months or a year, right? Growth has been strong for the last few quarters. But maybe what we've done is now looking ahead, we should be talking about, okay, is there going to be a hard landing or is it going to be a soft landing, right? The longer we keep rates here before the Fed actually cuts, that might cause some economic harm. What, maybe later this year, 25 or 26, we might see a recession, something like that in the future. It's coming. But what we're looking at here, the Fed has not cut rates yet, but we wanted to look at and say, what are the implications essentially for extending duration of a portfolio, and why should you consider doing that if you think the next move from the Fed is probably down versus more hikes again?
Right. Right. Typically after the Fed's done raising rates, right, the yield curve is inverted, which it is now. And when the yield curve is inverted, that typically means, that shorter term rates are earning you a higher yield than longer term rates. So, in that environment, what should I be doing? And what we find is that, and we're looking at here on the left hand side is where the 2-year U.S. Treasury yield was a month after the last Fed rate hike, and then where the 10-year U.S. Treasury yield was, right? And we find that oftentimes the 2-year U.S. Treasury yield is higher than the 10-year.
Yep.
But does that mean we should be hanging out in the 2-year? Does that mean we should be hanging out in the money market, the 5% money market fund? Well, when you look at history and you say, all right, after the last rate cut, how did bonds actually perform? And we looked at short-term U.S. Treasuries versus long-term U.S. Treasuries. And what we find is long-term U.S. Treasuries end up earning you more in total return than in the higher yielding at the time short-term U.S. Treasury. And that's because it's important to think about locking in the higher yield curve when it's high. If we're in a money market fund, or if we're in a 1 year or a 6-month U.S. Treasury, it's earning more, but that Treasury, that 6-month U.S. Treasury is going to mature in 6 months. And in 6 months, where our rate's going to be at, our yield's going to be lower. If yields are going to be lower, then you're not going to get as high as a return. If you're in a money market fund and rates go down, your yield on that money market fund are going to go down with interest rates. But if we go out and we extend duration and we lock in, let's say, a 10-year U.S. Treasury bond yield, then you get to benefit from that higher yield curve environment for 10 years, even after that higher yield curve environment leaves, right? So, and if you look at different indices like the 7 to 10-year U.S. Treasury bond, what we're seeing is you're about 11% below par. So bonds mature at par, bonds mature at 100, okay, when they mature. And so you get two factors in your bond return. You get the yield plus that growth to that par value if you're currently trading under par. So when we look at that, you can accept a 5% money market, sure, but then also you're looking at the about an 11% price appreciation potential in that 7 to 10-year segment, plus the roughly 4.5% bond yield, depending on where in the market you're looking, right? So that's a total return of about 15%. Now, it is possible that you have to wait till that bond matures to get that price appreciation. But in a lot of environments, what happens is the Fed lowers interest rates, and that means the price of your bonds start to go up either to par or above par, and you can immediately benefit from that increase in value there.
Right. It doesn't mean that you have to hold the 10-year Treasury for 10 years, but over the next 2-3 years, it could end up being a profitable investment if especially if we do see a recession and the Fed starts aggressively cutting rates to stimulate the economy again. Let's say the 5% money market and 5.5% Fed funds rate dropped to 2-3%. All of a sudden your 10-year Treasury at 4.5 is going to be trading well above par, probably, right? It has more appreciation to go, and you could continue to hold it to maturity. But in that type of scenario, maybe stocks have dropped, and maybe it makes sense to sell that Treasury and go long some stocks again.
Right. Well, back of the napkin math, right? If rates go from 5% to 3%, right? That's a 2% decline. If you have a duration of 10, your price theoretically back of the napkin math should go up 20% plus the income that you're earning. And what happens when the economy starts to go into recession is the Fed is forced to lower rates. So holding fixed income, especially longer duration fixed income, creates more of a ballast for your equity side of your portfolio. So it creates that hedge or another safety mechanism to add diversification into your stock bond portfolio. Now,
Yep.
to be clear, this is different for different investors, right? If your time horizon is short, we're not advocating for you to go into a 10-year US Treasury. Um, your duration should match your time horizon, right? So if you have if you have expenses coming up in the next 6 months, right, stick to 6 months or less with your US Treasuries. Look at it that way. But if you do have an intermediate to longer term outlook or goal that you're investing for, then it could make sense to go from shorter duration bonds at this point in time to a little farther out. And maybe for you that's just a 5-year U.S. Treasury or a 6 or a 4. But we're using the 10-year U.S. Treasury just to show how this works, right? To give you that mechanism to put it on a chart for you and give you an idea of what we should be thinking about.
It's a complicated subject, and we're spending a lot of time on it, but it's for hopefully a good reason. And the point I think the listeners should take is that even though face value a 5.5% 6 month treasury is higher yielding than, let's say, a 5% 2 year or a 4.5% 10 year, you can benefit a lot more over the long run because there's so much reinvestment risk when that 6 month or even the 2 year comes due. Where are rates going to be in 6 months or in 2 years, right? And if we do expect at some point there's either going to be inflation coming down and moderating or a recession, and in both of those scenarios, rates should come down.
Right. And the US Treasury is a great black and white example because there's less going into how a US Treasury is priced. But the same can go for municipal bonds or corporate bonds, right? There's just more factors there. So we felt it made more sense to chart this out using the US Treasury where there's less factors that go in. But the same applies for municipal bonds and corporate bonds.
Yep.
Now,
definitely.
so before we jump, so we have a question that came in. Does buying T-bills accomplish the same thing? My understanding is it needs to be bonds to capture the value change in the principal. So what happens is, so a T-bill matures within 12 months, right? So the farther you go out in duration, the more amplified this mechanism becomes. So yes, T-bills do work relative to a money market fund, right? T-bills will allow you to stay invested in a higher yield curve for longer when rates come down. However, if we were to go out to a 2-year bond or to a 3-year or 4-year or 5-year bond, as opposed to a 1-year or 6-month bond, you would expect that price appreciation to be more when rates come down. So yes, it does accomplish the same thing. But depending on your time horizon, you may want to think going out farther than T-bills, unless you're holding that T-bill as a cash alternative. If you're holding it as cash alternative, you want to stay within the T-bills. But if you're holding it within an intermediate term allocation, where you have an investment goal that's 5, 10, 15 plus years out, you may want to consider extending that duration even more.
Yeah.
So another question that I've been getting more of is, we're at all-time highs, or maybe I was getting more of this in March, but I think it's still applicable. But we're at all-time highs and I have fresh cash on the sideline. I'm hesitant to put that money to work, or I have money in stocks right now. We just went through 2022, where the environment wasn't great. 2023, the environment was great. Now we're at all-time highs. What should I be doing? Should I hesitate to put money into the market? So we took a look at it, and this is what we found.
So just like money market yields and shorter term yields being higher than longer term yields is, and what you should do is counterintuitive. This is also surprising data to me, and a little bit of that counterintuitive nature. So we'll start on the left side of this chart. this is looking at what your average returns are, based on your when you actually put cash into the market over different durations. So the first bars we'll look at are the gray and the green bars for a 3-month period. And what this is saying is if I invested on every single day, what was my return 3 months later? Versus the green bars are if I invested only fresh cash when we closed at a new all-time high the day before. Okay. And what you can see is on a short-term basis, you get a better return by investing over all days, right? So when the market is not at an all-time high and has a pullback, you'd expect better returns in the future. And this on a short-term basis is intuitive, right? This is, if you thought about it and use your intuition, this is what you would expect even across longer term timeframes, but that just isn't the case. Once you start to extend your time horizon out beyond 1 year from that investment point, you get a better return, even investing on days that hit all-time highs. Even over a 3-year period, there's nearly a 8% better return versus, sitting on your hands and waiting for a pullback. You're better off just getting the money into the market, which is quite interesting.
Yeah.
You do have corrections and pullbacks from time to time, but they're short. Sometimes they're steep, but over longer time frames, a new all-time high is a powerful message from the market.
Right. And that's why the 3-month time horizon, right? We find that just staying invested earns you a higher return than only investing at all-time highs, right? Staying invested through any period versus investing at all-time highs. But the way I look at this is, well, for that 0.6% return you're picking up, does it really make sense versus what you're risking? Because what you're risking is a lot of upside, right? When you go out further on further time periods, strength begets strength. So actually being at an all-time high is actually generally a good thing for an investor with a time horizon 6 months or longer. So if your time horizon is 6 months or longer, investing at an all-time high really shouldn't bother you. And waiting to put that money into the market or thinking about taking that money out of the market just because we're at an all-time high, historically has not been a great investment strategy.
Right. Stock prices being high today or at an all-time high today does not mean that things are good today. Stock prices are future anticipated earnings of companies in the market. So looking out 9, 12, 18 months into the future. So an all-time high is saying not only are things good, but we think things are going to continue to stay strong into the future. So I think that's an important aspect of this that people sometimes forget. I mean, there's always a million reasons to worry about what's going on today and now. You could go back every single year, and even at the beginning of this slide, we have, that 3-month viewpoint and all the quotes that come along with what's gone on over the last 3 months and all the reasons to worry. Yet the market still goes up over time. So getting the money in, if you're sitting on, 5% is nice. Don't get me wrong. 5% in a money market or a high yield savings is great, but you're not going to get 40%, 40+% over a 3-year period sitting in a 5% vehicle. Now on the right side, we just wanted to look at how often are there actually market corrections following an all-time high. So if you say, okay, well, I do want to wait, I do want to be patient, and I can get 5% right now, what's the likelihood you're going to basically see a better time to invest? And if you go a year out from an all-time high, over 9 out of 10 times, you're not going to see that level again, pretty much, right? And it goes down to nil. Once you hit an all-time high, you're probably not going to see that level again 5 years out. That's pretty powerful. So, for those people that do want to wait and feel comfortable with the 5%, I'm not going to fault you for that. But if this money should be in stocks, you should not wait.
Right.
It's not worth that 9%, likelihood. You're basically rolling the dice, a 10-sided die here, and hoping that you hit the number, and that stocks are going to be lower in 6 months, a year from now to invest your cash.
Right. Only 1 out of 10 times does it pay to actually wait to put that money to work. Right. So your choices are you can accept the average annualized returns of the market, which are what, 10% annualized, or
10% and volatile,
right,
right?
and stick with it, right, and be willing to go through the 10% correction, but capture those 10% annualized returns from the market, or you have a 1 out of 10 chance of waiting and the market goes down and then you put the money in. Those odds, I don't really like those odds. I'd rather be on the 9 to 10, chance that, everything's going to be fine. And, if the market does correct 10% or lower, I'll have the wherewithal to hold tight through it, especially when we look at the 5 year time horizon where after a new high, the market has never been down greater than 10% after that new high.
Yeah, this goes back to 1950. So,
Right.
maybe the Great Depression
Correction there.
would
So
be it.
yes,
Maybe the Great Depression would fit
it's a
that
good call.
criteria. But okay, we just went through 2008. I don't know if we're going to have something as bad as the Great Depression ahead. It's possible. Anything's possible. But again, that's why it comes down to, should the money be in stocks and you're just sitting on the sidelines and comfortable because you're getting 5%? Or is this part of a fixed income basket and it's more short term money that you do need the stability? Then it makes sense to be more opportunistic and roll that dice essentially. But I think this would be a really interesting study to look out and say, hey, what does this look like if you're, what do the 3 and 5 year numbers look like if you're 3 years removed from the last bear market? That
Right.
would be pretty interesting, because then you say, okay, market cycles are 5 to 7 years. We're probably due for a bear market in the next 3 to 5 years. But we just had one in 22. The economy seems to be doing pretty well. Again, if the money should be in stocks, just get it invested.
Right. So another, just to continue the counterintuitive nuggets that we have today for everybody, we wanted to talk about small cap versus large cap, specifically small cap US versus large cap US, because I feel that if you were to go out to the public and ask people what has performed better over the last 25 years, people would hands down say, oh, well, large cap, of course, large cap.
Yeah.
And there's been this gravitation away from these other asset classes like small cap because large cap has performed pretty well recently. So we rolled up our sleeves and looked at the data
As we do.
as we do. And what we found is large cap has not outperformed, right?
No, it not only has it not outperformed, but we could be due for some regression to the mean, because it has outperformed over the last several years, really since 2019 with spits and starts and fits. But we'll start at the bottom on this table, and then we'll cover the two charts at the top second. But just looking at the performance here, when we put this data together, Austin, I remember we spoke with the content committee and kind of said, hey, let's not cherry pick from the start of the tech bubble. We were going to go back to 2000, and we said, let's go back a little bit further, so we can include some of those really great years when large cap did well in 98 and 99.
Right.
And even including that, you can see that annualized returns of the S&P 500 since Jan 1 of 98 are about 8.3%. The S&P 400, which is the mid-sized companies, so this is sort of that 10 to $50 billion range, is kind of in this 10% range. It's actually done a little bit better than small cap stocks, which is the S&P 600. That's around that $2 to $10 billion size market capitalization companies. That's come in at 9.22%. So mid and small cap companies have actually done better on an annualized basis since 98 than large cap companies. It's surprising considering how well large companies have done in just the last handful of years. Now, I think it's worth noting that with these higher returns, if we can expect those in the future, we should also expect more volatility in order to get those high returns. That's called the risk premium. If you want more return, you're going to have to take on more risk. That's measured by the standard deviation. So what you can see is that the S&P 500 actually has a lower standard deviation. This is the variance in those returns along the way. So there's the S&P 500 for that lower return, you are getting a less volatile index, right? Versus 18.5 and almost 20% standard deviation for the mid and small cap respectively.
Right.
Now, okay, that's great. We get higher returns with mid and small cap over long periods of time. But let's look at what are the best and worst returns of these different size indices. And that, we'll start with 1 year on a short-term basis. I think what's fascinating is the best 1 year return for the S&P 600 was a whopping, small caps, was a whopping 95+% return. Okay, so you basically doubled your money in the best year since 98.
Right. In one 12-month rolling period.
In a 12-month rolling period. This is not just annual, but we looked at it on a monthly basis. So any consecutive 12 months. The mid caps are, 83+%. The best return for large cap stocks was over 50%, 56%. Now, that's a massive jump, right? And you'd expect that with a more volatile asset. But what's interesting is the worst year, the worst 12-month period, was actually worse for large caps. Large caps were down 43% more. Mid caps and small caps, their worst 12-month period was down just 42% about.
And this is a different measure of risk, right? Something, standard deviation, what that is looking at is the variance in returns. So the swings in your returns and how often it happens and how wide it happens. Now, standard deviation, when it's higher, generally means higher risk, but also a higher returning asset, generally by default, that standard deviation is pushed up a bit because it keeps growing, right? So if we look at risk a different way, your worst 1 year return, this is actually telling a slightly different story. Now, I wouldn't necessarily say that, this data is saying, oh, well, large cap is that much more risk than small and mid, because the difference is not that big. But what it's telling us is, large cap did go down more or just as much as small and mid cap in their respective worst 12-month periods.
Yeah, it's the difference between the best returns is far greater, right? It's like a 40% difference in the best returns for small versus large cap, but the worst year is still basically the same, which is interesting. Now, you flip this on its head and you look at a longer time frame. So this is 10-year, or you could even go out to 20-year periods. But the worst 10-year period for large caps was still negative, believe it or not. This was probably from 2000 to 2010, that sort of period, you saw a negative return. But over that time period, small and mid caps were still positive, which I think is, a testament. That's a bigger difference there on the worst returns. And you still had, the best 10-year period of outsized returns in small and mid caps. And if you extend that out to 20 years, it looks even better. So, compound a 1 or 2% difference over a 20-year period, and that's really impressive.
Right.
So let's talk a little bit about the charts up at the top here. I'll start at the top right, and what we've seen, we alluded to it, but large cap, when this blue line, this is a ratio chart here on the top right, but when the blue line is dropping, that means large caps are outperforming small caps. And when the blue line is rising, that means that small caps and mid caps are doing better than large caps. So what you can see is really since about 2018, 2019 or so, with exception of a few fits and starts, large caps have been doing well over the last 5 years or so, but that's not always the case. Okay. In the mid 90s, you saw small caps do well. The late 90s, large caps did well. All through the 2000s bull market, small caps outperformed. And even really from coming out of the great financial crisis through 2017, smaller companies outperform large companies.
Right. So what this is telling us is it's more unusual for small caps to underperform large caps than we may think, right? Just because large caps have outperformed over the last several years, right? That's not necessarily historically the norm. Small caps
Right.
typically do outperform large, and that makes sense because you're taking on more risk by investing in a smaller company. So you should get a higher return, theoretically from making that investment.
Yeah, so, we've talked about this, and someone brought up the point that, well, those small companies that did well over that time period are now the big companies that are doing well, right? So is it just we should keep piling our money into those same companies, right? The Netflix and Apples of the world that were small caps now are large caps and giants, and we should invest in that. I mean, for every one of those examples, I could point to like Tesla was, not a large cap, or Nvidia was not a large cap really, and a massive company until just the last couple of years,
Right. They
right?
just recently broke into the top 10, let alone the top five.
Right. And, you could look at Apple, and Apple hasn't done well this year. I think it's down like 10% year to date, and the market's still up, 4, 5, 6%. So there's a massive performance gap there if you've gone ahead and piled all your money into a company like Apple.
Right. And
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 you,
in the past we have looked at, well, what if I only invest in the top companies, right? Because if you go back each decade, if you go back to the 60s, the 70s, the 80s, the 90s, and you look at the top 10 names in the S&P 500, those names were vital to the economy at that point in time. And I bet you that if you teleported back in time and you asked people, about this, they would say there's no way that company is not going to be in the top 10 15 years from now. And guess what? Typically, we see the top 10 names fall out of favor in a 15, 20-year period, right? And new names replace it in terms of
yeah,
size, in terms of market share of the economy, right? So, and
go
if you
back
were
to 1950 and the 50s and ask them if they would ever see a world without Eastman Kodak
right,
or Xerox, right?
right, exactly.
Those are, I mean, those are two of the largest companies in the world at that point in time. But where are they today? I don't know. People still do fax and scan things, but
Yeah, I was going to say, well, ask an 18-year-old what a Xerox is, and I bet you that they may not even know.
right.
So, and we actually looked at investment approaches where you invest in the top 10 names and then you fast forward 15 years, how has it performed? And on average, it vastly underperforms owning the other 490 names from that period going forward. So, this is something that we've come across before, decade after decade. This thought process we've come across before, and just investing in those top 10 names doesn't make sense, right?
No,
It's not a great investment approach.
no, and there's a couple. We'll look at forward valuations for a second, but then we can talk about why small caps have maybe underperformed like the last couple of years, specifically. You can, on the top left chart, you can see that the red line is the forward price to earnings ratio of the S&P 500. That's the valuation of these companies. How much are investors willing to pay? What multiple are they willing to pay for stock prices? And you can see in the late 2000s was a period where large cap companies were higher valued than small and mid companies. The blue is mid cap and the green is small cap. And then pretty much every other time, large cap companies carry a lower valuation than small and mid. And that kind of makes sense, right? You would expect a riskier company, you'd have to pay more for their earnings. And we're back in this gap here where people are paying more for the earnings of large cap companies than they are for the earnings of small cap companies. And so, look, this is not a forecast today saying small caps are going to outperform, but they are cheaper relative to large cap companies. These are trends that we've seen across decades in the past. And at some point in the future, it just goes to the point should be made that you should diversify and have proper exposure to small and mid cap companies within your portfolio, and not just expose yourself to the biggest companies in the world right now, even though it seems like chip companies are going to take over the world.
We're not saying flock into small and mid cap US companies. What we're saying is small and mid cap shouldn't be ignored, right?
Yeah.
It belongs in a portfolio. The extent that it belongs in that portfolio is really dependent on your goals as an investor, right? And that pot of money, what the goals are for that pot of money. But we shouldn't ignore them. We should keep them in consideration. They have a place in a portfolio, one for their return potential, and then two for diversification. When large caps are doing well, sometimes small and mid caps aren't. When large caps aren't doing well, sometimes small and mid caps are. So it's a great way to, add additional diversification to the portfolio to some extent.
Yeah. I mean, let's look at the market environment that we're in, and we can hypothesize here that maybe one of the reasons why small caps have not done as well throughout the last couple of years is the fact that there's higher interest rates,
Right.
right? Small cap companies are much more dependent on lending to grow than some of these cash cows, like the FANG stocks, right? So, maybe if lower rates are ahead in the future, that could be a huge catalyst for small cap stocks.
Right. If you think about it, right, to further that, if you think about a small cap company, when they borrow, they more than large caps have to borrow at a variable rate. So when interest rates go up, their borrowing cost on that debt goes up. When interest rates come down, their borrowing cost on that debt goes down. So if you think about a profit and loss statement, you have your revenues, then you have all these other payments you have to make for expenses. One of those is debt payments, right? If your debt payment is higher because interest rates are being held at right above that 5% level, then your profits are going to be smaller. But if that debt payment goes down, right, because interest rates go down, your profits become larger and you become more profitable. That is likely why towards the end of last year, when the market started pricing in 6 rate cuts in 2024, small and mid cap stocks outperformed large by roughly 10% to end the year. It's reverted this year where large caps are outperforming small and mid cap because to some extent, or to what I believe is a big extent, because the market went from pricing in 6 rate cuts to only 2 or 1, right? So that
Yeah.
impact on their bottom line, that forward forecast on what the small and mid cap stocks bottom line is going to be has changed, right? So, is it possible that small and mid cap stocks see a tailwind as rates come down? It's very possible. And we'll see what happens. Now, there's other factors, right, that influence how a stock performs, but this is one of them, and something that we're looking at.
Yeah, definitely. Well, we had this. I would say this concludes our pre-planned slides for the day. We've gotten comments in the past week, started getting really tight towards the end of our presentations and rushing through things. So feel free to ask questions in the Q&A box below at the bottom of your screen. We're going to hang on as long as questions keep coming in. If not, thank you very much, as always, for tuning in. I know we have one question to get to here in a minute that came in beforehand.
Yeah.
But thank you again. And as always, listen, view, subscribe wherever you are catching this, if you're watching the recording. And thank you all for attending. One of the questions, Austin, we had come in that I'd love for you to answer is guidance on dividend stocks, and what our thoughts are there.
So I think within dividend stocks, if you're looking at, what the next attractive dividend stock is going to be, we should be looking beyond the dividend, right? So, your highest dividend name is not necessarily going to be your best returner. Or if you find a dividend name earning, a 10% dividend, right, that doesn't mean your return is going to be 10% annualized or more going forward. What you find is quality is a good factor to include when you're looking for dividends. So when we're looking for those next best dividend type companies, we should have a quality overlay, right? What are the profits looking like? Can they support that dividend? Are they growing in other ways, right? We can't overweight that dividend component. We need to also complement that with different ways of measuring quality.
Yeah. There's plenty of stocks that over the years people have piled into for their dividend. Ford is a recent example. It comes to mind, and then they go and they cut their dividend, right? People hold it. They hold thousands of shares just to take that dividend. Meanwhile, the stock's going down, down, down. GE was another good example of that, right? And then all of a sudden, these companies cut their dividends because the underlying business is not in a healthy position. So,
Right.
rather than sticking with one specific company, I would say, maybe target some sort of ETF or a fund that focuses on, like you said, both quality and dividend as components for how they structure their portfolio.
Right. Right. Or baskets of individual names as we do for many of our clients that are more fixed income, for more income focused.
Yep. That would be a solid point. Yeah. And then we had a question on the latest in the step up in basis changes to legislation. This is honestly news to me. I would say if you are a client, you can reach out to your advisor, or we'll get in touch with you and find out a little bit more about that. Or a tax professional may know the answer to that specific question as well.
We do have professionals on our team that have a very strong focus on financial planning and what's going on in those areas. So we'd be happy to get you in touch with them. Also, to plug Amplified Wealth, right? We have Amplified Wealth, and then we have Amplified Wealth According to Plan. Amplified Wealth is more general. It's a general podcast. You can look it up on YouTube or any of your favorite podcast apps. And then any of the titles that say Amplified Wealth According to Plan, those are from two of our financial planning experts. And they just focus on financial planning type topics. They haven't focused this on the step up in basis yet, but maybe that's to come.
Awesome. Well, thank you very much, everyone. We will give you all 3 minutes back of your day. I hate saying that, but we will cut it here a little bit early, and hope you all have a wonderful rest of your week.
Great. Thank you.